Palantir is up 178% year to date, and in this video, I am going to do an in-depth analysis by looking at the financials of the company, the balance sheet, and using my EXO spreadsheet to calculate the intrinsic value of the company. Starting with the financials, this company has grown revenue between 20 and 40% for the last 4 years. However, if we take a look at quarterly revenue, the growth percentage has come down. Moreover, analysts are expecting this company to grow around 20% for the next 3 years. In terms of profit, they recently became net income positive, but they have been free cash flow positive for 2 years, which is very good. And their net income and free cash flow are going to continue to grow as they have very high margins, with gross margin being consistently close to 80%. In this regard, analysts are expecting them to make 67 cents per share in 2027. If you assign a 25 PE to the company, that would make it a $16 stock, which means negative 6% returns. So far, the financials look good. Now the question becomes, can we pay a reasonable price in order to make a good return on our money? In order to answer this question, I used my EXO spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis and did low, middle, and high assumptions. Right now, you are seeing 6 numbers. The top 3 are based on net income and the bottom 3 on free cash flow. They mean 2 things. First, that in order to make the desired annual return that I have put in, you need to pay these prices. Second, if the low assumptions occur, you are going to make a negative 4% annual return on your money. If the middle assumptions occur, 7%, and if the high assumptions occur, 20%. Therefore, the company is only a buy if you believe the high assumptions. I would say I have an interest in the stock at around $10, as I believe my middle assumptions are more reasonable. Because I have the company growing at 20%, which is what analysts are expecting, having 28% free cash flow and profit margin, they should achieve this as they already have a 22% free cash flow margin. I also assigned a 23 PE and price to free cash flow to the company and left shares outstanding change at 0%. The EXO spreadsheet does not address any value to the balance sheet, and this company has a near-perfect balance sheet with $3.2 billion in cash and only $236 million in debt. Moving on to the pros and cons of investing in this company. Starting with the pros, this is a company in a sector with a lot of potential that is growing fast regarding revenue, net income, and free cash flow. They also have fantastic margins and a perfect balance sheet. On the other hand, the valuation looks expensive. Apart from what we have seen on the EXO spreadsheet, they are selling for a price to sales of 18. Just to put this into perspective, Google is selling at a price to sales of 5. The stock price has fallen recently because there are concerns with the renewal of an army contract, and Palantir makes money by making contracts with government and private companies. 60% of their revenue at the moment comes from the government. However, they are growing the commercial sector at a faster pace than the government sector. In my opinion, this is short-term news that shouldn't affect the long-term trajectory of the company. In conclusion, I would like to own this stock, but not at the current valuation. The price you pay for a stock is important and determines what returns you will get in the future. I hope you enjoyed the analysis. Let me know what you think about Palantir in the comments, and I'll see you on the next one.